Welcome to the Finding Financial Freedom podcast with the Frugal Physician, where Dr. Disha Spath will be your companion on this exciting financial adventure. Get ready to conquer debt, build wealth, and embrace a mindful spending lifestyle that will empower you to live life on your own terms.
Welcome back to another episode of Finding Financial Freedom with the Frugal Physician. I'm your host, Dr. Disha Spath, and today we have a great guest joining us, Sean Mullaney. Sean Mullaney is an advice-only financial planner and the president of Mullaney Financial and Tax, Inc. Through Mullaney Financial and Tax, Sean provides advice-only financial planning for a flat fee. Sean writes the Plutus Award-winning blog FiTaxGuy.com on the intersection of tax and financial independence. He also has a personal finance YouTube channel and wrote Solo 401k, the Solopreneurs retirement account. Sean has a wealth of experience helping self-employed individuals and small business owners navigate their retirement options. We'll be discussing all things Solo 401k, how to maximize your savings, take advantage of tax benefits, and secure your financial future. Whether you're a physician with a side gig, a practice owner, or a full-time entrepreneur, this episode is jam-packed with insights just for you. So let's dive in. Hey, Sean, how are you today?
Disha, I'm doing great. Thanks so much for having me. Looking forward to the conversation.
Yeah, I'm really excited to have you on. Sean, can you please tell us a little bit about yourself and your journey in finance?
Yeah, so my name's Sean Mullaney. I'm a financial planner in Woodland Hills, California, which is part of Los Angeles. And I'm actually a career changer. So, undergrad and college, I was an accounting major. And my first career, which lasted for the better part of 17 plus years, was in corporate taxation. That career took me through PwC twice, Deloitte and Touche, the IRS, and law school. And, during that time, I had this itch to scratch on personal finance. On the weekends, I'd look at the Wall Street Journal Weekend Investor. I used to watch Susie Orman, right? So I
hmm
sort of followed personal finance from the sidelines, applied it to my own life. But that was it during my first career. And eventually the itch got such that I had to scratch. So in 2019, I opened my own financial planning firm, and I've been doing advice only essentially financial planning for it'll be 6 years next March, a little over 5.5 years now. And I've been very happy with that. And as part of my getting out there, I do some thought leadership content creation stuff. So that's a YouTube channel, it's a blog, FiTaxGuy.com, and it's a book we'll be talking about today, Solo 401k, the Solopreneurs retirement account.
So we just did an episode on how to pick a financial planner, and there are a few key questions I asked my audience to ask financial planners. So I'm going to ask them to you. Number one, are you required to be a fiduciary at all times?
Yes. So my credentialing is in terms of my individual credentialing. We can talk about my firm's credentialing in a second. My credentialing is I'm a certified public accountant licensed in California, Virginia, which means as I practice, and my financial planning is the practice of accountancy, right? You can look at the California law, and that's quite clear. If you are a CPA, you owe your clients a fiduciary duty, right? So when I interact with clients, I am a fiduciary.
Do you sell any products?
Well, so what I sell to clients is advice only. So go to my firm website, MullaneyFinancial.com for the particulars. But essentially, what I sell is advice. Through my firm, I sell advice. I don't sell insurance. There's no assets under management. There's no commissions or anything like that.
So you're a fee only practice then?
Yes. So my firm's billing model is project based. It's a flat fee and it is fee only. There's one limited exception to that. My firm does offer extensions of projects where normally it takes 90 days for a flat fee. There can be 30-day extensions where that's billed out at an hourly rate, but otherwise it's a entirely flat fee model.
And since you're a CPA, do you do your clients' taxes as well?
The answer to that is no. So I used to in my own practice do, a handful of tax returns. That's now down to one and only one. So no, for new clients, the only thing my firm offers is financial planning.
I bet you have a lot of insight to offer, though, when it comes to the tax code and how the financial plan plays into it.
Yeah, so the way I approach it is I'm a tax focused financial planner in that my interests tend to lie on the tax side, right? Financial planners touch all sorts of areas: estate planning, insurance planning, investments, retirement, taxes, cash flow. It depends on the particular financial planner. And so I touch on those areas. I just happen to have an intellectual interest on the tax side that might be a little more heightened. Part of that's from my first career, part of that is just from personal interest.
Well, I can imagine that that's really impactful in your advice that you give. But let's switch gears and dive into that solo 401k book that you wrote. You wrote an entire book on the solo 401k. So I am super excited to learn from you about what the solo 401k is and what some of the other options physicians have if they own their own practice or have a side gig. So, Sean, can you start by explaining what a solo 401k is and how it differs from the traditional 401k or an IRA?
Yeah, Disha. So a solo 401k is a 401k for self employed persons. And that could be through a so called S corporation, it could be through a sole proprietorship. Those are generally reported on one's tax return on what's called a Schedule C. And so this is a way, you go to a large employer and they have a 401k program, and HR sends you an email link. Here's the portal, make your contribution election, make your investment allocation election. And when you start working for yourself, there's no one from HR to send you that email. So you got to do it yourself. Now, the tax laws luckily allow us to do it ourselves through a financial institution, generally speaking. And so a solo 401k is essentially a retirement account for those folks who work for themselves, either on a Schedule C or through a so called S corporation. There's several nice things about a solo 401k. One of them is you are in control. You get to choose the financial institution, the level of contributions, the investments in there, right? It's not corporate HR at your employer that's contracting out and selecting the investments. So I think that alone makes the solo 401k a really attractive thing. The other thing about it is, when you work a W 2 job, many employers have some sort of employer match or employer contribution, but the employer, you got to remember, is in business to make money. So there's only so much they want to spend on their employees. So if you think about a typical employer, maybe they'll match up to 6% dollar for dollar of your salary into the 401k as the employer contribution. And that's actually a pretty generous match, but that exists in
Mhm.
the world. If you're making even $200,000, say, well, that's a $12,000 so-called employer contribution. Well, the employer contribution when you're in a solo 401k is much higher in terms of the legal limit, and that sort of a scenario depends on how it's structured. But you might be
Mhm.
looking at 30,000 or 40,000 or more of an employer contribution in addition to the employee contribution. So the solo 401k, in terms of the limits of what we can get in there, tends to be a lot higher than a regular 401k. One of the nice things about the solo 401k too is it does share a lot in common with its large employer cousin, the regular old 401k. Some of the advantages are you get to do your own financial institution and investment selection, and you get to make contributions based on what tend to be higher limits because it's not limited by the profit and loss motivation of a large employer. It's only limited by your available cash, essentially, and by the statutory limits, which are pretty high.
Yeah, if I recall correctly, the solo 401k employer contributions can be anywhere from 20 to 25% of your profits.
Yes. And it's a little complicated here in the sense that a Schedule C solopreneur has a different calculation than an S corporation solopreneur. So if you're an S corporation, which I know is common in the doc world, right? Certainly
Mhm.
not 100% true, but among doctors, there's often a legal entity involved because of just legal liability reasons, not necessarily tax planning reasons. And then the compensation might be high enough where, hey, you know what, you've made the so-called S election. So for that person, it generally is 25% of W 2 income. Now, there are limits. We could talk about those limits, but pretty high as 25%. For a Schedule C person, it's 20%. And it's a little bit of a funky calculation, but let's just call it 20%. That's the legal limit essentially for a Schedule C person. So a little less for a Schedule C, but 20 or 25% still a big number regardless.
Yeah, so a Schedule C, just to clarify, those are LLCs and other pass-through entities?
Well, yeah, so let's talk about that. So a Schedule C is a number of things, actually. It's one, just doing a business in your own name, right? So I'll give you a little example. I have a little YouTube channel. The profit from that little YouTube channel, which is not large, that gets reported on a Schedule C. It's just done in Sean Mullaney's name. Okay. But it could be something else, right? It could be a so-called LLC that is disregarded for federal income tax purposes. So what do I mean by that? There are these limited liability companies that people own, and they default to a status. If there's only one owner, it defaults to disregarded status. It's as if you do it in your own name. So if you do
Mhm.
nothing, it's just going to be disregarded. And that income goes on Schedule C as if it was a sole proprietorship. So those are the two main Schedule C examples. Now, there could be self employment income from a partnership too, that exists in the world. But the two main ones are either in your own name or an LLC that's disregarded. What's the compare and contrast to an S corporation? So, an S corporation exists sort of in two examples in the world. One is an LLC that you elect to treat as an S corporation. So, you might own an LLC, it defaults to this disregarded Schedule C status, but then folks make the so called S corporation election a lot of times, especially doctors who tend to be higher income professionals. Not always, but a lot of people make that S corporation election. So that's one example where you'd be an S corp and you'd be paying yourself W-2, reasonable compensation, that sort of thing. The other time is there are situations, my home state of California is one of them where this comes up a lot, but it can come up in other contexts where people operate out of an INC, like a regular corporation, like Apple Computers. A doctor might be operating out of one of those. And in fact, in California, I'm not giving you legal advice, but as a practical matter, folks out here sort of know, oh, yeah, if you're a professional, you probably are required by California to operate not out of an LLC, but out of an INC. Talk to your lawyer about that. So there are going to be people out here in California, but this exists elsewhere too, where folks say, okay, I'm operating out of an INC. It will either pay corporate income tax or I make this S corporation election. So the income goes up on my own tax return. Oftentimes that's the advantageous tax play. So those are the two times where we might have an S corporation in the picture, either an LLC that we elect to be an S corporation or an INC that we affirmatively elect to be an S corporation.
So, a lot of physicians that I know do locums work or some other type of work that is a 1099 contractor income. A lot of them ask me, is it advantageous at all for me to start an LLC? And in the setting of a solo 401k, what would that imply, whether they
Yep.
had 1099 income or just had an
Yes.
LLC it was going through?
There's sort of two planning plays on the table there, Disha. One of them is legal liability. And look, I'm not a practicing lawyer, so I'm not going to give anyone legal advice on this podcast. But at least in theory, if one has an LLC, and one takes clients through that LLC and something goes wrong, the party that could be sued, at least in theory, is the LLC, not the individual owner, right? So people will do the LLC for legal liability reasons. And that could be it. You might say, I don't want to do any additional tax planning. Now, you might say, hey, I like that S corporation thing. So I'm going to make this S corporation election. Now, there's trade-offs whenever we make an S corporation election. And sometimes from a solo 401k perspective, it's actually a favorable trade-off. Sometimes it's an unfavorable trade-off. It does change. So when we do solo 401ks, we have two different contributions. We have an employee contribution. As we sit in 2024, that's 23,000 maximum. Next year it goes to 23,500. And then there's a catch up if you're 50 or older, it's 7,500 for both years. That one isn't really all that affected by do we do an S corporation or not.
Hmm.
The employer contribution can be because when we make our employer contribution, it's based on our total business profit if we're a Schedule C, but it's only based on our W-2 income if we are a S corporation. So that can affect it. Now, for a very high earning doc, it may not affect it much at all because the numbers are just so high, they all just hit the maximums. And in fact, all in maximum for a solo 401k in the year 2024 is 69,000. It goes up to 70,000 in 2025. And then you could add the catch up contribution as well if you're 50 or older to up that even further. So we're talking about some pretty big numbers, especially for your higher earning docs. But even for a doctor who maybe isn't as high earning, it still could be a lot of money can get in there. So, and not that we always have to max out, but it is a nice, powerful planning opportunity to get a very sizable tax deduction and a whole lot growing tax deferred or even maybe tax free for our future retirement.
So then that begs the question, what if a physician is W-2 employed and has an employer 401k? Can they
Yep.
also do a solo 401k? And then how does that relate to their 1099 income if they're just doing Schedule C
Yeah.
without
So
an LLC?
Disha, you're raising a great issue. And I have a whole chapter in my book about, I call it side hustlers, right? But this would be
Mhm.
the exact situation you're talking about. Doctor has a W-2 job, 40 hours a week. And then on the weekends, they do some side hustle work. In theory, they absolutely can have a solo 401k, but it gets a little tricky. Couple things to keep in mind. One, the limit for the employee contribution, let's just assume we're under age 50, 23,000 year 2024.
Mhm.
That's your limit as an individual for all 401ks in the world. So if you're
Okay.
already maxing out your 401k at your traditional job, okay, that's fine. It means your employee contribution at your side hustle piece is zero because you've already used your maximum. All right, but does that mean a doc can't have a solo 401k on the side hustle income? No, the doc can absolutely still have a solo 401k for the side hustle income, but he or she could only contribute as an employer to that solo 401k. Now, by the way, maybe they haven't maxed out at work. Maybe they don't like the workplace plan, so there's still some limit there or something like that. But they can have a solo 401k. It can only be supported by the self employment income from the side hustle. It cannot be supported by the W 2 from the main job. So that's important to keep in mind too. Sometimes folks don't understand that the limits for the solo 401k are determined in terms of employer contribution and employee contribution too, based on what the side hustle, that self employment itself generates. It has nothing to do with your W 2 other than your W 2 maybe reducing the employee contribution.
So this is an incredibly important tax play for physicians, especially for high earning physicians. Maxing out the 401k is not an issue, the work 401k. And if you have side hustle income, then you have another bucket where you could be putting tax protected income. So let's talk about those tax protection and how that money grows. Are the physicians there able to make Roth contributions to solo 401ks?
Yes, so let's talk about that. And anytime we talk about some of these contours in our plan, we have to think about the tax rules. So that Congress passes that, the IRS and Treasury publish regulations, right? There's tax rules that govern our solo 401k, and then there's plan rules, right? So as we go to the different financial institutions out there, their solo 401ks have distinct plan rules. And anytime we're trying to do something with our particular solo 401k, we have to thread both needles. So let's
Mhm.
talk about that. Roth contributions. Yes, it is absolutely possible to make Roth contributions to a solo 401k. However, not all solo 401ks offer Roth contributions. And in fact, this changed, I believe it was January 1, 2024. Don't quote me on that. But for the longest time, Schwab said, we don't have Roth contributions in our solo 401k. Well, sure enough, as of 2024, they now have Roth contributions. My understanding is Fidelity still only has traditional contributions to the solo 401k and does not have Roth. Now, that said, these things can change over time. So go to their websites. Don't take my word for it. I would go to their websites to validate that. So it's absolutely possible to contribute to Roth. Now, the whole traditional versus Roth, that's its own
Whole other
episode, and
thing.
we could debate that all day, but it is out there, but not every plan offers it.
So the solo 401k is not the only plan an individual can invest in if they have side hustle income or are a solopreneur. We also have the SEP IRAs, simple IRAs, defined benefit plans. Can you tell us a little bit about those and why you would invest in a solo 401k and when you might choose the
Yeah.
others?
So I'll start with the one that I think has the least applicability for the doctor audience, and that would be the simple IRA. The simple IRA is a retirement plan that is sort of for small businesses that have multiple employees. If you don't have multiple employees, you're just working for yourself. it's a hard one to justify adopting in my mind. But if you have 5 people and you want to give people a option to make a large or a somewhat large employee contribution and give them a small employer contribution, simple IRA could be the way to go. It's rarely, if ever, the way to go for a solopreneur. And it has disadvantages. One of the big disadvantages is for the first 2 years, a simple IRA has to stay in a simple IRA. And if you don't, there's a substantial penalty, for not keeping it in a simple IRA. So I tend to not like the simple IRA, but in the right profile where we have, maybe 3, 4, 5 employees that are particularly loyal that we want to keep, that could be the right answer. All right. So that's a simple IRA. The big one, especially for doctors, is the solo 401k versus the so-called SEP IRA. And for the longest time, the rules essentially had the contribution limits be the same between a solo 401k and a SEP IRA. Then what happened? In the year 2001, there was a huge tax bill, right? This got passed, I think, in late May of 2001. I remember it as a rookie corporate tax practitioner. It was big in the news then. It had scores of individual tax changes. And you got to remember, Disha, this was a time without Twitter, without podcasts, without the white coat investor and, choose a FI and all this stuff, right? So this change went under the radar. And it basically said, well, now you can have a solo 401k where you both make an employee contribution and an employer contribution. Prior to that, everybody just did SEP IRA, SEP IRA, SEP IRA. The solo 401k was a theoretical thing, but to my knowledge, didn't really have much practical application. The SEP IRA has the better deadlines, particularly back then. So tax return preparers loved it. You could do it up to the extended deadline. You didn't really have to plan it. You just said, all right, what's my income this year? What's my SEP IRA contribution? Write the check before you file the tax return and you're done. And the 2001 bill changed that to very little fanfare. And the tax return preparers didn't have much incentive to adopt it because they liked having clients come to them after the year and just doing their SEP IRA. So the solo 401k sort of fell through the cracks. And then, the world changed, right? We had more solopreneurs in the world. We had more content creation in the world. And people sort of discovered it and said, wait a minute, you could put a lot into the solo 401k. And so today in the SEP IRA versus solo 401k, for most people, it's still true that the total maximum contribution is going to be higher on the solo 401k side than the SEP IRA side. SEP IRA is a little easier to manage. The deadlines are a little better. There are cases, if you're making over $1 million, the SEP IRA, the simple IRA isn't all that different. The other one is the so-called backdoor Roth IRA. The solo 401k is much better for the backdoor Roth IRA than the SEP IRA is. So that's a reason maybe you do the solo 401k, even if you were just at the max of both and the numbers are going to be very similar. So that's the solo 401k versus the SEP IRA. And then for doctors, there's something out there called the defined benefit plan. Sometimes it's referred to as like a cash balance plan. This is an area I actually don't spend a whole lot of time in. These plans can be very lucrative, but now you're adding to complexity, you're adding to administrative fees. These are the sort of plans I would recommend mostly for doctors who are going to be long-term high income doctors. I think if you're going to be very high income and you're going to be doing that for a long time, and the tax deduction today is just so valuable, it's worth looking into, but you're definitely amping it up in terms of complexity, in terms of fees, and it's less flexible than a solo 401k or even a SEP IRA, or certainly a SEP IRA.
I'm glad before you mentioned that the backdoor Roth IRA and how solo 401ks versus SEP IRAs play into that when we're talking about the pro rata rule, because a lot of the doctors that listen to this podcast are doing the backdoor Roth as well. So the solo 401k really helps to make the backdoor Roth possible because then you're not trying to tax all of the savings you have in your SEP IRA.
Yeah, and Dish, I sort of high leveled that point, right? So backdoor Roth IRA is a workaround the income limitation on the ability to make an annual Roth IRA contribution, right? There's this backdoor Roth, which is a workaround. It, by the way, that rule is a terrible rule, right? In Canada, they have a Roth IRA equivalent. There's no income limitation on 401ks. You make $1 billion, do traditional or Roth, but for this 7,500 Roth IRA contribution, whatever the limit is, oh, we're going to step in and say we have this low income limit. It's a silly rule. So the world has developed the backdoor Roth IRA to get around the silly rule. However, there is a fly in the ointment. And what that fly in the ointment is what you referred to as the pro rata rule. And that's it. So what that says is if you have other traditional IRAs, simple IRAs, or SEP IRAs, the big one for doctors, if you do a backdoor Roth, the second step of that transaction, first step's a non-deductible traditional IRA contribution. Second step is a conversion of the non-deductible contribution plus any minor growth to a Roth IRA. If you have no other traditional IRAs or SEP IRAs, that's an almost entirely tax-free transaction, right? There might be just a little incremental tax on a little bit of interest or dividends, but no big deal. But when you have a large SEP IRA, well, now you have a problem because in the non-deductible traditional IRA contribution, you create, they call it basis. And if you have other IRAs or SEP IRAs, those attract the basis, and the Roth conversion step only attracts a very small amount of the basis. And so you've just made your so-called backdoor Roth IRA almost entirely taxable, which during your working career as a doctor is probably not the right answer. So, well, how do I avoid that? If I have a big SEP IRA, this pro rata rule bites me. If you had a solo 401k instead of the SEP IRA, well, now that money doesn't count against the pro rata rule. And now you can do your backdoor Roth IRA, have no other traditional IRAs, simple IRAs, SEP IRAs, and now you're in pretty good shape. So the backdoor Roth IRA is one of those, it's a great little tactic, but just keep two things in mind, right? One is plenty of people in human history have become very wealthy without a backdoor Roth IRA. So it's just a tactic, right? It's not the be all and end all. And two, you want to think about your time frame. If we're talking about a doctor who's going to, start a 25, 30, 35-year career, they should be thinking about the backdoor Roth because if they do that every year for 25, 30, 35 years, oh boy, oh boy, oh boy, that could be a lot of Roth assets by the end of that time. But if you're listening to this and you're like, I got 1 or 2 more years and then I'm retiring and I've never done a backdoor Roth. Look, if you have no traditional IRAs, SEP IRAs, or simple IRAs, it might be the right thing. But you might say, oh, I have this old rollover traditional IRA that's worth $3 million. I don't know if I'm in the last 2-3 years of my career. I don't think I'm going to be doing much structuring to move a $3 million traditional IRA just to get 3 years of a backdoor Roth. Does
Sure.
that make sense, Disha?
Sure. Yeah, absolutely. That extra compounding in the early career can definitely add up over time in that Roth IRA. And I want to make sure I don't confuse our listeners. The backdoor Roth IRA is the individual retirement account that anyone can have. In this episode, we're talking about accounts that you can start when you are also a solopreneur, side hustler, you have your own business or income that's not coming from a traditional W-2 employment situation. Or you're one of the doctors that has a traditional W-2, but also has income as a side hustler and then can also start that individual retirement account. So you can have all three of those buckets. So those are separate buckets, separate categories. And I do have a chart on the Frugal Physician. If you sign up at the website, you can download it so you can see more visually what I'm talking about. But those are three different categories of retirement accounts.
It sets up like a starter 401k. I would think long and hard before adopting a starter 401k or really any retirement plan, especially for other employees, right? I think that's the sort of thing where you really need some professional assistance. If you're doing a solo 401k, there are plenty of Americans who are DIY and solo 401ks. Doesn't mean they shouldn't have advisors. But I think the second we're taking responsibility for someone else's retirement, especially one of our own employees who in theory could sue us one day, I think we just got to be dotting I's, crossing T's, and getting one or more professionals involved. If you're interested in the starter 401k, and I'm not even sure how many financial institutions offer it.
What point does the plan become subject to additional reporting requirements like IRS Form 5500?
The solo 401k is more complex to set up than, say, a SEP IRA. So, for example, a solo 401k has an adoption agreement where the financial institution will actually have you sign a legal agreement about the contours of the plan. It's the sort of thing that if you got through signing up for the MCATs, signing up for the SATs, getting a passport, getting a driver's license. It's the sort of administrative burden that folks who can do that can probably manage, but at the same time, it's not nothing. Now, in terms of the annual maintenance, it's not so bad, although I will say it's a good idea to always validate your contributions at year end. So, what I would do is, in the following year, I would have a little schedule where you compute your income and you compute the contributions that were made and just reconcile and prove out, that you made the right types of contributions. There's no excess contribution in there. And then there is occasionally these plans need to be restated, right? So what that means is the financial institution offering the plan may say, okay, it's been a few years and the laws have changed. So we're going to restate the plan. And then as the plan sponsor, either your business or your S corporation, you should get a document from the financial institution. You got to sign it. It might be an e-signature these days, but you got to make sure that the plan is appropriately restated from time to time. The financial institution usually takes the lead on that. And then the last thing is, the 5,500. So what this is the government has reporting requirements with respect to employer plans. So like if you're Apple Computers, presumably they're filing a very large form every year reporting their large 401k. I'm just guessing, but presumably they're doing that. Now they have special rules for one participant plans, solo 401ks. And what that says is this. It says you're subject to the annual form 5,500. However, we're going to accept you from that if your assets at the end of the plan year are $250,000 or less. So when you're starting out, it's difficult to file a 5,500 form. But they say in two situations, you have to file the 5,500 form. One of them is if your assets at the end of the year are in excess of $250,000, you have to file a form 5,500. The second one is if you close down your solo 401k, then too, you have to file a form 5,500. Now, the good news on that is they have a special rule that says, well, if you're only a one participant plan, you could file a form 5,500-EZ, not the regular 5,500. And that's the form 5,500-EZ is about 3 pages. It's just not all that complicated. So that makes it a lot easier. But yes, anytime your assets at the end of the year are more than 250,000, or you shut down the solo 401k, you need to file with the IRS the form 5,500 EZ. I believe there's a Department of Labor online alternative, but the paper 5,500 EZ is so easy. I've never really looked into the Department of Labor alternative on that, but I believe that's out there as well.
So yeah, I know of people that have rolled over their previous 401ks from employers and then taken a bunch of money, put in their solo 401k. So if that's the case, I guess probably the 5,500 needs for you to differentiate what was a rollover and what was the actual contribution.
Yeah, to be honest with you, Disha, I'm not even sure. But here's the thing: the rollover creates the need. If you have a $300,000 401k at your old employer, you roll it to your solo 401k. Now all of a sudden, you need to file that 5,500 EZ. I will say, while we're on the topics of roll-ins to solo 401k, I
Mhm.
tend to disfavor them. I'm not here to say never do it, but I think one thing about plans, people don't get this, is plans need to be qualified. And it's not that high a hurdle, right? Meaning the plan technically needs to meet IRS rules. And you're rarely going to wake up and read the Wall Street Journal. These days, not many people read the Wall Street Journal. It's a different time in the media landscape, but that's a different conversation for a different day. But assume you read the Wall Street Journal every day. You're not going to find like, oh, huge public company had their 401k plan disqualified. And there are reasons for that. Now, hopefully the main reason is their internal compliance people are doing a bang up job, right? And there's no faults, but there's also risk and harm involved, right? If you're the IRS and you say, oh, I'm going to go into this big public company and disqualify their 401k, that's going to create a huge taxable event in the lives of thousands of people. And those people are going to get in touch with their congressman. And now the IRS has a headache on its hands, right? So the strategic incentives at the IRS are not to be, meddling with every little, dotted I and crossed T at these large plans. Well, is that the incentive the same if they're dealing with your solo 401k? I'm not here to scare people, but I'm here just to put the incentives on the table, right? The IRS, if they were to disqualify your solo 401k, they're dealing with one and only one person. The harm in that case is not thousands of people. So I say, boy, I just want to be very careful before I roll a significant amount into a solo 401k. It's not something I lose a ton of sleep over, but I just want to dot some I's and cross some T's. The issue is if you roll $1 million 401k from your old workplace 401k into a solo 401k, and the IRS says something about your business or how you maintain the solo 401k or anything like that, now you have the risk that $1 million went into a non-qualified plan, which is just a taxable event. That's a terrible outcome. It's one of those things that I certainly wouldn't assign a high probability to, but because the numbers could be so big, even a super low probability makes me pause and hesitate. So I just think the world has seen millions at this point of roll-ins to traditional IRS, a much safer transaction. The world simply has just not seen millions of roll-ins into solo 401ks. And so I think it's just one of those, let's just slow our roll a little bit before we're going to do a massive roll-in into a solo 401k, especially if it's going to be somewhat tax motivated by a perfectly legal transaction, by the way, the backdoor Roth. We just want to be very careful with something like that.
So what would you advise people that have a large previous employer 401k and now they are solopreneurs? Where would you put that?
So that one actually, Disha, if I wanted to write a second book, that could be the second book. But I'll give you a few nuggets for the time being. My experience has been that the world is getting better in terms of large employer 401ks. All right, so you work for a large employer, you leave at age 40. I left a large employer at age 40.
Mhm.
And so let's say you're like me, you leave a large employer at age 40 and you're going to start self-employment. Great. Leaving the old 401k simply where it is might be a very valid planning alternative. It may be that that old 401k has low fees and great investments. So what do we need to be in a hurry to move this for? Right. So that's one potential possibility. Second possibility is a rollout to a traditional IRA. There's reasons you might want to do that. Could be account consolidation. It could be because you like a particular financial institution, their investments, right? There are absolutely valid reasons you might want to do that. And then a third option would be to roll it into another employer plan. Maybe I'm at employer A and I have a 401k. I leave them and either I go to employer B or I start self employment. Now I could, in theory, either roll to employer B's plan and maybe it's a better plan, or I'm self employed. Maybe I roll to the solo 401k. There's different alternatives. There's no, this is the answer. One other thing to at least consider is creditor protection. 401ks tend to enjoy the best creditor protection in the world. If you roll to an IRA or even a solo 401k, you may diminish that. Now, I will say there's something called personal liability umbrella insurance that can help make that up at a relatively affordable price. In some states, by the way, IRAs have tremendous creditor protection. So it may not be that much of an issue, depends on your state. So, Disha, yeah, there's a ton of stuff to consider when we're leaving. We've got an old 401k or other retirement plan at an employer. Sometimes the best move is leave it where it is. Sometimes the best move is roll to an IRA. Sometimes the best move is bring it to the new job. It really depends on a multitude of facts and circumstances, including but not limited to ease of transfer, investment selection, fees, creditor protection issues. Yeah, that one could be its own book.
So I do want to mention if you roll to an IRA though, like a traditional or rollover IRA, then you can't do the backdoor Roth.
Disha, that's a great point. And that's another factor. That would be a reason to either leave it in a old employer 401k or move it to the new employer 401k, which in your case might be a solo 401k.
All right. So with all the changes in tax laws, I know we've gone over so much already and I've taken up a lot of your time, but I just want to hear from you. Look into your crystal ball and tell me, where do you see the future of retirement savings going, particularly for entrepreneurs?
Yeah, this is a great question. And Dish, I'm going to share a little of the behind the scenes of the podcast recording process, if you don't mind, with the
Of course.
audience. So we are recording this on November 4th, and November 5th just happens to be election day. And I will say, I do believe the election is relevant to the answer to this question. But of course, we don't have early returns on November 4th unless Disha has a DeLorean and 1.21 gigawatts of electricity, But assuming you don't, Disha, I'll give you a more broader comment, which is the listeners are going to see in the content creation space some big names talking about Roth, Roth, Roth. We have a $35 trillion deficit. They're going to be taxing retirees to the moon. You got to be in Roth, right? And I actually have a blog post on this, and I document 5 very big names in personal finance that have basically come out Roth 401k, Roth 401k, Roth 401k. I take a bit of a different approach for a number of reasons, right? One reason is I look at the political incentives of Congress, regardless of party. And you know who tends to vote? Retirees. So why are they going to be in such a rush to increase taxes on retirees, right? When retirees tend to vote. So I question this. Oh, yeah, retirees are just going to have all these additional taxes in retirement. I worry about that.
Mhm.
Second thing is the Roth community ignores progressive tax brackets. When we work and we're at our highest tax rates, we take a deduction into a traditional 401k at our marginal benefit, the top rate.
Mhm.
When we are retired, we get to go back up through the progressive tax brackets. That in retirement, we tend to have lower income, not higher income. So it means a lot of our old traditional 401ks are going to come out against the 10% bracket, 12% bracket, 22, 24%. So if we deduct in at 35% and then take back into income at 12%, 22%, 24, 32, we're still making money on the government and we're better off than if we had done the Roth. So that's another thing. Third thing I'll point out is a little bit of congressional history. And I'm sure, sadly, this may be where the audience tunes out. Please stay. This is actually really good. You look at the years 2017 to 2022. We actually had changes in presidential party, some changes in Congress. Those years, regardless of the composition of the White House and Congress, had these small tax cuts after small tax cuts for retirees. 2017 Tax Cuts and Jobs Act, 2019 Secure 1.0, 2020 we had the CARES Act, we had new regulations that lowered RMDs, 2022 we had some tax cuts for retirees. I did a YouTube video on this very subject. I say, well, wait a minute. The commentators for years have been saying that retirees are going to have more and more taxes in retirement. Well, why do I have 5 examples in a half decade where, in eras of high deficits and debts, they kept cutting taxes for retirees? Retirees are a favored constituency. So I struggle to say, oh boy, you're a sitting duck with these traditional retirement accounts. I'm not here to say it's a risk free proposition. Don't get what I'm saying wrong. I'm not saying never do Roth. I think there are times where Roth makes a ton of sense, particularly in an early retirement, low tax Roth conversions, backdoor Roth IRA. There are times where the Roth really is very attractive. But I think this sort of concern that drives up fear about taxes and retirement, I just don't see it based on those factors.
That's really good to know. And yeah, I tend to agree with you because the retirees in this country do have a lot of power simply because they do end up getting out to vote. This is not going to air until after the election is over, but I hope everyone got out to vote. And if not now, go for the next election. It's very important. And you do have a lot of power that way. So, Sean, this has been an incredible conversation. Thank you so much for the detail that you've provided and the historical outlook on our finances. Where can our listeners find you if they have more questions?
Disha, thanks so much for having me. I really appreciate it. You guys can find me on my blog, fitaxguy.com. It's the intersection of tax and financial independence. And on YouTube, put Sean Mullaney videos in the search bar and you will find my channel. I publish a video every Saturday morning about personal finance.
Well, please go check that out. I know our listeners will walk away with some valuable insights on how to boost their retirement savings and take advantage of this powerful tool, the Solo 401k. Sean, thank you so much for joining us today and shedding light on the incredible benefits of the Solo 401k. I know our listeners will walk away with some valuable insights on how to boost their retirement savings and take advantage of this powerful tool. For those interested in diving deeper, I highly recommend picking up Sean's book, The Solo 401k, The Solopreneurs Retirement Account. It's an excellent resource for anyone looking to take control of their financial future. As always, thank you all for tuning in to Finding Financial Freedom with the Frugal Physician. If you found today's episode helpful, don't forget to subscribe, rate, and share it with your colleagues. Until next time, stay frugal and stay financially free.
The content shared on this podcast should not be taken as individualized financial advice. We are here to share our knowledge and experiences, but it is crucial to consult with professionals such as accountants, financial advisors, or attorneys who can provide personalized guidance based on your specific needs.